Hello. Welcome to the show, everybody. This is Graham Neary with Taking Stock. Thank you very much for joining me. We've got an action-packed show today with many companies reporting. We've got the likes of Ultimate Products, Animal Care, Venture Life. We've got hVIVO. We've got Warpaint London, a whole host of companies, some big caps as well. So plenty to cover. I'll try to cover things as efficiently as possible. One point of order. I know people yesterday were looking for timestamps. So from now on, I'm going to put the timestamps in a comment under the video on YouTube. So even if you can't find the timestamps in the description, which you should be able to at some point in the afternoon or evening, but the timestamps will definitely be in the comments on YouTube. So look for them there, and you'll be able to fast forward to whichever companies you're most interested in. Or you could just watch the entire show, whichever you prefer. Hello to everybody, whether you're in the live chat or in the video or in the replay. Please do say hello if you're in the live chat. I appreciate getting a little bit of feedback in the live chat. It helps a lot. Okay, so let's get started. And I think we'll begin with Warpaint. Let me just get my screen sharing. Hello, thank you, Elsaint. Thank you for the hello. I appreciate that. Okay, so let's go to Warpaint first. Just as an aside, I have a brand new computer. I've just unboxed it, and I'll hopefully be setting it up this afternoon after today's show. So we'll have a better quality of production from tomorrow if I can get it set up this afternoon. Okay, Warpaint. So this is quite a nice company, quite a big market cap now as far as small caps go, £328 million, and we're up 13% today. So this is a company which makes affordable cosmetics. So I think I have seen management from this company present, and the basic idea is that they're following the trends of sort of the luxury or the more fashionable brands. Warpaint is basically copying them to some extent, while also having staple products which are sort of evergreen. They also have the fashionable stuff which copies current trends. Anyway, let's get into this trading update, which has seen the shares go up 13% today. So Warpaint London, the specialist supplier of color cosmetics and owner of the W7 and Technic brands, they are pleased to report that strong trading has continued in Q1. Sales in Q1 are a record first quarter for the group. Sales to the 31st of March of £23.5 million, 28% ahead of the same period last year, and margins continuing to be robust and ahead of those in 2023. Accordingly, given this strong start to the year, the outlook is now expected to be ahead of the market's current expectations. So very good stuff. I would love it if companies could put their expectations in the RNS, although it's not really standard practice yet to do so, although hopefully more will in the future. Future Investing says hello. Thank you very much. I appreciate that. All right, and what's the final point here? Cash balances totaled £7.5 million after investment in a significant increase in stock to satisfy expected demand later in the year. So yeah, overall, I'm a fan of this business. probably not its biggest fan. I know it has some huge followers out there, but let's remind ourselves of what sort of financials we can find on this page. So again, we've only got published out to 2022 here. So, but I think the key point here is that this is a legitimate growth stock, and it's a legitimately profitable company, and seems to be doing everything right. I have given it the once over before, and I haven't found any faults with it in terms of governance or execution. Everything seems to be very impressive over at Warpaint. So I guess that makes me a fan of the company. Can it justify the current market cap? I think that's a challenge, but when you invest in growth stocks, people often not that they turn a blind eye to valuation, but they tend to pay a lot up front for future growth. So all good here at Warpaint. So, and well done to them for beating expectations. Let's see now. I've got a long list of stocks to look at today, so bear with me now. Where will we go next? Will we have a look at hVIVO? Actually, I can go to the Vox homepage for hVIVO. Because I think there's an interview, and there's also to this one. All right, so let's just take a quick look at this article from the Vox homepage. So they've announced final results for 2023, and I think the outlook here is in line. Saint says Venture Life also had news out today. Yes, I'm hoping to get around to Venture Life as well. So hVIVO. So this was formerly known as Open Orphan, if I've got that right, and it's specializing in human challenge trials. So they've reported a revenue increase of 16% to £56 million, an EBITDA increase of 44% to £13 million, and an EBITDA margin of 23%, up from nearly 19%. So a lot of people very impressed with hVIVO today. I recommend checking the Vox archive here, because there's I think we've got a CEO interview as well. Yes, so there's a CEO interview here as well on the homepage, which I would invite you to check out for further information on hVIVO. So yeah, a lot of people very impressed with this one, and the CEO talking about a £100 million revenue target. Let's drop back to the so formerly Open Orphan. Market cap £192 million. So the £100 million revenue target still a few years away, but at decent margins. No reason why they can't justify that market cap. It's not my area of expertise, but certainly an interesting story, and they've been at it for a few years now. Open Orphan before then, as they were formerly known. So they've developed a pretty good track record over recent years, and well done to them. Okay, let's move on to we do Venture Life. We'll do Venture Life because Saint suggested it, and why not? VLG. Okay, so this one is down 7.5%. I think we've got some Vox material here. Yeah, so we've got an interview with the CEO of Venture Life. That's quite recent. That's 1st of February. So that's definitely worth a look for further insights. And let's check out the update. So we've got final results from Venture Life. Has its fingers in a few pies. And I've in studying it in the past, I did feel like it perhaps had its fingers in slightly too many pies. It was had quite a few different types of products in its portfolio. Right, we've got a question from Informer. Why does everyone say the UK market is undervalued when 100 and 250 FTSE all-time highs, great yields, and doing buybacks? Well, it's a good question. The way I would answer that is when people say the UK is undervalued, a lot of the time, if it's people like me, we're talking about small caps, which aren't the 100 or the FTSE 250. But you are right. The FTSE 100 has been doing pretty well, led by the oils, I think mostly. But yeah, it's the other point is just on valuation that there's always that discount between the UK and US markets. But yeah, I don't think the FTSE 100 is hugely undervalued personally. That's my opinion. But yeah, let me know what you think. All right, let's go back now to Venture Life. So we've got group revenue up 16.9% to £51 million. We've got 18 new stock keeping units contributing 6% of group revenue. Various new listings achieved across UK retail. That's quite impressive. 28 new listings. And online revenue up 40%, although still reasonably small at £4 million. We've got an adjusted EBITDA result of £11.6 million and adjusted profit before tax of £7.3 million. And I can see the statutory profit before tax is £1.1 million. So quite a large discrepancy there between adjusted profits and actual profits, which I guess goes with the territory when there's probably quite a lot of acquisitions involved here. Moderate leverage, group net leverage at 1.3x. And then we've got a trading update for the new year. We've got ERL in Tesco and Amazon, further UK distribution gains, and new products in the pipeline ready for launch. So yeah, this one, like I said, I have found that it's got quite a lot of different types of products in the portfolio, which I have found a little tricky to get my head around. But it's certainly a stock that I keep an eye on over the years. I've always had an interest in it, and yeah, check out the interview with the CEO for more on that one. Could be worth a look. Okay, let's go. If you'll let me just go and look at the big caps for a minute. I think we've got an update from Imperial Brands, so I will come back to the small caps, but I just want to take a break from the small caps for a minute to look at this one. Yeah, Future Investing's got a question on Gresham Technology takeover. I will come back to that one. That is a good, an important story. So I'll be coming back to that one very soon. Let's just check this one out. Imperial Brands. Interesting. Somebody was asking about the FTSE 100. Well, this is This is clearly in the FTSE 100. I'm a shareholder in BAT, British American Tobacco, which has the ticker BATS. So I like to have an idea about what's happening at Imperial. So we've got a pre-closed trading update from Imperial Brands, and they are on track to meet guidance. So let's just take a quick look at the headlines here. Strong tobacco pricing supporting financial delivery while balancing share performance. So these enormous companies, keep are very clued into their market share, obviously. So there's always that balance. They want to maintain market share without, while also maintaining their prices, of course. So they're maintaining stable aggregate share in their top 5 combustibles markets. And the next generation product net revenue growth as we build scale and launch new products. Okay, so next generation products generally refers to pouches and e-cigarettes and other non-combustible products. And we've got first half adjusted group operating profit ahead of last year on a constant currency basis, reflecting higher tobacco and next generation product profits. Okay, so all in line there. I must say, as somebody who's owned BAT for quite a few years now, it's quite a weird one, because I can't fault the company at all, really. The only thing I would prefer is if they spent more on their buybacks rather than on their dividends. I feel like these tobacco companies have been trading at such cheap multiples. They could really have bought back an awful lot more shares instead of paying dividends. But apart from that, I can't fault them. They've generated enormous amounts of cash. They have returned the cash to shareholders mostly, and they're on track with next generation as well. Although even that has been difficult, because regulators, of course, don't have mixed views about vaping and e-cigarettes and so on. So there is that prospect of increased regulation, which has impacted my my BAT holding, particularly in the United States. They've been pretty active in terms of regulating vapes. But anyway, we've got a £1.1 billion buyback program here at Imperial Brands. So market cap £15 billion. That £1 billion buyback is material. That will make a significant difference to earnings per share, and yes, that is a big deal. Let's scroll down a little bit more and see if we can get something on the outlook. Okay, so yes, I suppose this is the main point. Adjusted operating cash conversion remains strong, and we are on track to deliver in line with our guidance. We expect full year leverage to remain at the lower end of our 2 to 2.5 range for net debt to EBITDA. So, the leverage here is not crazy. If you look up the bonds for these companies, I think you'll find some pretty decent credit ratings. I haven't looked it up recently, but I'm pretty sure British American Tobacco is BBB rated on the bonds, so investment grade, and that should, well, it certainly gives me some confidence as an equity investor that the equity is not extremely risky. But yeah, I remain interested in this sector. Obviously, people have ethical concerns, which is fair enough. But yeah, I think these shares are worth keeping an eye on, and I do own BAT, and I'd certainly be open to owning Imperial as well in future. So yeah, I'm glad to tick that one off. That was worth looking at. Okay, let's head over to Gresham Tech. And thank you to Future Investing for the suggestion. Okay, so this one is up 24%. And we have another company, a small company, market cap £134 million currently. But another company leaving the market. And I suppose this goes back to the question we got in the live chat from Informer, who's saying, why does everyone say the UK market is undervalued? I suppose this is the answer. And it's not really happened in the FTSE 100 so much, but across the small cap market, we have lost a rather large number of companies to takeovers. And as I said in a show recently, private equity tend to be very good at timing their exits and timing their acquisitions. And when you see private equity buying up listed companies, I think it's a sign that that the listed markets are very pessimistic. Let's take a look at this offer. So we've got 163p in cash. So current share price 160p or thereabouts gives a few p for people to hang on to receive if they keep holding this one. Okay, there will also be a small dividend. Okay, and it's fully recommended by the directors. And now we've got this sort of explanation as to why they're doing it. So they remain confident in the execution of strategy. However, the board recognizes that uncertainties and risks exist to the delivery of that strategy in the short to medium term. This is something that many boards say to shareholders when they recommend a takeover. They say that they want to provide certainty to shareholders. So that's not nothing too revolutionary to say that. But they are saying that there is the end markets are challenging and consolidating, and customers are slower to replace legacy technologies, which can impact Gresham's sales pipeline. They want to become a £100 million annual recurring revenue business, but this is reliant on significant investment in R&D and sales and marketing. And they say competition remains intense. And they say many of their competitors are often larger, privately owned, free from the constraints and the requirements of the public markets, and backed with substantial financing. And so they're basically saying that they need to delist or go private in order to fund high levels of organic growth and participate materially in the expected consolidation of the financial services data management software market. So, I mean, they're basically saying that the public market is not not the place for them to do this. Is not the place for them to be a growing company that's investing in research and development, which is quite sad, really, that they don't think that the public markets can provide that for them. They say that the valuation, the cash offer values Gresham at 12.9 times adjusted EBITDA and 30.8 times adjusted cash EBITDA for last year. So they consider those multiples to be attractive, and I have to agree. Now, the question we had in the live chat from Future Investing was that 5x seems to be the norm that private equity is paying for UK businesses. So I'm not sure if you're talking about a PE multiple there. You're clearly not referring to Gresham, because this is a very high multiple that's being paid against adjusted EBITDA. So I'd have to argue that this is an attractive price. But they point out that the shares are illiquid and that the low level of liquidity can make it challenging for shareholders to monetize their holdings in the market, should they so wish. So, yeah, it's a shame that the company's leaving, but I'd have to argue that is a decent valuation, very decent multiple being paid. And let's see about the premium. So the premium is 26% or 27%, let's say, to the closing price as of yesterday. So I would say that is a good premium. It's not great, but it's not sort of spectacular, but I'd say it's okay. I wouldn't say it's disappointing personally. And Future Investing in the live chat says he's referring to the ARR being 5x, the annualized recurring revenue. Okay, thank you for clarifying. Okay, so in terms of annual recurring revenue for software businesses, yeah, if it's true that private equity is only paying 5 times annual recurring revenue, then they are doing very well against what the companies would sell for in the United States. So it is difficult to get to pin this down exactly, but my impression is that in the US, a software business will trade for at least 5 times annualized recurring revenue, and that you're more likely to see an average of about 6 to 7 times for software. And in very bullish markets, you can even see numbers like 10 or 12 times. I mean, you can go and download NASDAQ data to try and get a handle on this. But yeah, I think if that's true, that UK businesses are being sold at 5 times ARR, then that is cheap. But then, yeah. So with Gresham, the argument is, well, it's a great price against EBITDA, but maybe it's not such a great price against ARR. And yeah, Future points out that Gresham had 30 million pounds of ARR in the last update. So yeah, so on that basis, you can argue that they're getting it at a decent price or a cheap price. Against earnings, it's expensive. So yeah, it's kind of just like, even now when I write about other companies, say over at Stockopedia or other places, if I say that a software company is cheap because it's trading at only 4 times ARR, for example, I know that argument is still foreign to UK investors. I think a lot of UK investors are resistant to using a price to sales multiple or an EV to ARR multiple. A lot of UK investors want to use PE or worst case use an EBITDA multiple, whereas Americans will use price to sales or EV to ARR. And so, yeah, in this case, if this company could grow to 100 million pounds ARR in subsequent years, and if it could be sold to American investors, and if those American investors were feeling very bullish at the time and were willing to pay 10 times ARR, well, then you suddenly have £1 billion valuation instead of 130 or whatever it is now. So yeah, that is the difference. Yeah, it's an interesting argument, and yeah, I still think that many, I won't say most, but many UK stocks are undervalued, and I think the takeovers continue to back me up. It felt like we had a few weeks there without any takeovers, but now we've got a new one here with Gresham. I'd be curious to know if you're still in the live chat, if you agree with what I've said there. But yeah, I can see this one being accepted by investors, especially that they're if it's currently trading at 160p. It seems like people may be holding out for more. Excuse me, people may be willing to accept the 163p total. Okay, I might move on to another story now, but that is a big one, and I'm glad we've covered it. Let me just tick it off my list. Okay, let's move on to Ultimate Products, ULTP. Okay. Yeah, so this one changed its name quite recently. What was it called before? UPG. So now it's Ultimate Products. It's got some brands which I think are pretty decent. They're not high-end products by any means, or high-end brands, but they're good brands. Let's see if we've got any media here. Yeah, there's some media here in the archive to check out. And let's have a look at this. We've got interim results today, and we've got a proposed share buyback. So let's open this up. Okay. Yeah, and I think they've got Russell Hobbs on license as well, if I'm not mistaken. So this is definitely a decent company. I've been monitoring it for a good few years now, and it's definitely churns out good results more often than not. But let's see what they've got to report for us for the interim. So they're in line with expectations to January 24. Total revenue down 4% to 84 million. Supermarket ordering held back by well-documented overstocking issues, which are now easing. And they also point out that there were strong prior year comparatives. Adjusted EBITDA, £11 million. And this is a very positive sign when you see the statutory profit before tax tracking very close to adjusted EBITDA. That gives me a lot of confidence that the adjustments are reasonable and not too big. We've got statutory EPS down 3% to 8p. Of course, higher UK corporate tax kicking in there. And very modest gearing, very low gearing, net bank debt to adjusted EBITDA only 0.4x. So very, very, very low leverage. So that's all pretty good. Now this, okay, we've got some operational highlights, which is fine. And then just in terms of the capital allocation framework, this is interesting. This is a new target that they want net bank debt to adjusted EBITDA to be around 1x. I think that's pretty reasonable, you know. A lot of companies, well, you could argue all companies struggle with the decision of how much cash to keep or how much debt to use. You know, if you've got a reasonably mature, reasonably stable business that wants to have a lean balance sheet without taking too much risk, net bank debt to adjusted EBITDA of 1x seems like a reasonable target to me. They will also return 50% of post-tax profits to shareholders through dividends. And they're also looking to commence a share buyback of up to 10% of their share capital. So that is a meaningful buyback. Excellent news. And we've got a CEO comment. This has been another period of resilient performance for Ultimate Products. Macro conditions remain challenging, but our strategy of providing beautiful products at mass market prices to UK and European households is continuing to stand us in good stead. So all good there on that front. I'll say I'm very impressed with a 10% share buyback. You know, think of what that does for long-term EPS. Terrific. Of course, the main objection that you hear in relation to share buybacks, there's more than one objection you hear, but the biggest one is that companies overpay for their buybacks. So we'll address that as now in a minute. But we've got you know, you can see the margins here are not huge. They're selling this stuff at mass market prices. You could argue these margins are okay, about 25%. And let's consider valuation. So we've got statutory profit after tax of £7 million, and we've got a market cap of £134 million. So I'm not sure what the actually I could find out here. Let's see if we can get the full year. Let's see if we get a full year forecast. Equity development. They reckon that the shares trading at 4.7 times PE, and trading at 10 times EV to EBITDA. So opinion, but I don't think that Ultimate Products is overpaying for its shares here. It seems to me as if they're not trading at a very expensive multiple, and if they have confidence in the future, then returning money to shareholders in a buyback is probably not the worst decision to make. Of course, I could be wrong, and the company may be wrong, and they may have to eat their hat. But seems to me that this is not a crazy level to be buying back the shares. So yeah, I'm impressed. I'm very impressed, and I'd love to see more buybacks in the UK market. again, if we are undervalued, then we want to see more buybacks, and there's certainly no shortage of them right now. It's incredible, really. Every morning you get dozens of share buyback updates from dozens of companies. So it's all the rage right now. Okay, so that's Ultimate Products. I might actually save some of today's companies for tomorrow because I don't see how it's going to be possible to cover everything today. So look, we may keep some for tomorrow. Where will we go next? Maybe we'll look at PROC. All right, let's see. Yeah, PROC PLC. So this one is up 4%, and it says that it is the UK's leading direct-to-consumer specialist kitchenware brand. Market cap only £28 million, so fairly small. But I've got any media here? No media yet. And let's see what we've got. We've got a Q4 trading update. So marginally ahead of market expectations. Marginally, I would say is effectively in line, because when you see the word slightly, you should get a small increase. When you see marginally, I read that as being basically in line. So we've got revenue up 4.8% year on year in Q4. Still only up 0.4% year on year in total for the entire year to date. So it's not been a brilliant year in terms of growth, but it seems to have improved later on in the year. So they say continued market share gains with trading momentum improving. I suppose in such a tough year for the consumer, we could give the company a break for having some weaker numbers, especially at the beginning of the year. You can see there's a big difference between the retail growth and the e-commerce growth, and we've got like-for-like revenue here. So there's a lot of numbers to get your head around. I suppose the main numbers, if I had to focus on something in this table, I would say the main number is like-for-like revenue growth for the full year. That's the main one that I would focus on. It is down 2%, but Q4 was significantly better. So there's a story there of the company improving performance towards the end of the year. They say they've outperformed the UK kitchenware market by approximately 2%. So there's been an improving trend in every quarter. Let's scroll down to the outlook. So with strong margin and cost discipline, the board expects full year, or the financial year, to be between £500,000 and £1 million, marginally ahead of market expectations. And they've got market expectations of £0.4 million in a footnote. So as I said, it's effectively in line. If it only comes in at £0.5 million, then it's basically in line. But scope for it to do slightly better than that. Let's continue on with the outlook here. So they've opened new stores. They've launched a new small kitchen electricals range. They've improved the customer experience online, and they've delivered meaningful price reductions. Whilst the macro environment remains difficult for consumers, we are confident that the work done to strengthen our business over the last 2 years will support a stronger performance in the new financial year. And as conditions improve, enable the group to deliver profitable and sustainable growth for all stakeholders. So pretty confident words here, and I think the Q4 revenue update is sort of backs that up, and the fact that profits are slightly ahead of expectations or marginally ahead. And I suppose we've got to remember that conditions are very tough for companies, and things could look very different in a year or two. The CEO here uses the word subdued. Despite the market remaining subdued, we are gaining share, giving us confidence that our proposition continues to resonate with consumers. So he uses that phrase, profitable growth, which seems to be a bit of a fad right now. Everybody says the phrase profitable growth, but no, seriously, I think this is a good update, and this seems like a pretty decent company to me. Looked at it a few times in the last year, and reasonably impressed. So hopefully the good positive momentum can continue there. Cross that off my list now. Okay, let's take a quick look at CRTA. As I said, I'm not going to be able to cover everything today, but I'm going to circle back tomorrow and cover a few things from today. So we've got this is One Disco under a new name. Feels like I've covered this one quite a lot recently. Let's go into the RNS. This one had final results last week, and this results statement from last week included some pretty amazing sort of description of the turmoil that the company endured after its sort of the scandal it went through, which was about orders that didn't seem to exist, but which had been sort of promised to shareholders. So we've got a Q1 update, which is following on very fast from the final results statement, which is a bit strange to get a Q1 update so quickly. I mean, it's only been 5 days. You could argue that the Q1 update should have been in the final results. But anyway, bookings for the period of $0.7 million Q1 last year included was $2.1 million. So significantly lower there because we don't have a large renewal. Steady build in pipeline, 15 contracts signed, new business secured. All sounds very positive, and they've still got that cash balance. So this is a tricky one because previously the company's announcements of its orders turned out not to be credible, but hopefully under new management, it is now credible. You'd certainly hope so. And they say bookings will be H2 weighted as the pipeline builds and the sales team becomes more proven. So they've had to hire a lot of new salespeople and basically reinvigorate the entire team here. So I think it's going to take some time for this one to rebuild its credibility, but certainly with the new management team, they're doing the right things by just starting over, and hopefully they'll start becoming a company we can believe in over the next year or two. Certainly doesn't hurt when you've got new management and a new name. Okay, so I won't say anything more about that one, but I wish it good luck. Okay, so we're about 50 minutes in here. I think to avoid letting this one get too long, I might call it a day there. But I have got companies. I've got 1, 2, 3, 4. I've got 4 companies that that from today that I'm interested in still. So I will try to cover them tomorrow. If you have any specific requests that you'd like me to cover, please let me know. And if you're looking for the timestamps, I will put them in the comments, and you will also find them in the description. So you'll be able to flick around to whichever piece you find most interesting on the replay. As always, thank you very much for the likes. Thank you very much for the comments. I've had some people saying that I'm emming and awing too much. People say that I'm smacking my lips too much or whatever. People feel my presentation is not 100%. Well, I will continue to work on it. Rome wasn't built in a day, and hopefully will be improved on a number of fronts in the coming weeks. So thanks very much as always. Thank you for all the comments in the live chat. Thank you for your company. Hope today's trading updates helped your portfolio and didn't damage it in any way. And I look forward to seeing you again tomorrow. So have a good day, everybody, and thanks again. Cheers.